Respected viewers, dear family of truth seekers, I'm going to tell you something today that might upset you. Something that contradicts what you've been told your entire investing life. Something that goes against the gospel preached by every index fund evangelist and passive investing guru. But before you close this video, before you dismiss what I'm about to share, ask yourself one question: if buy and hold is such perfect advice, why are so many small investors still struggling? Why do they watch their accounts swing wildly while the wealthy seem to navigate every storm with ease? The answer, the uncomfortable truth that nobody wants to admit, is this: buy and hold is advice designed by the wealthy for the wealthy. And when small investors follow it blindly, they're playing a game with rules written for someone else's advantage. Let me take you back to a moment that changed how I see everything. It was 2008, the financial crisis, the worst market collapse since the Great Depression. I was sitting in my office watching the markets implode, watching portfolios cut in half, watching decades of savings evaporate, and I received a call from a man, we'll call him Robert. Robert was 62 years old. He'd worked his entire life as a mechanic, saved diligently, done everything right. He had 380,000 in his retirement account, all in index funds, buy and hold strategy, just like the experts recommended. His voice was shaking. They told me to hold and not panic, that the market always comes back, but I'm 62, he said. My account is down to 190,000. I've lost half my retirement. How long do I wait for it to come back? I asked him a simple question. Robert, when do you need this money? In 3 years, he said. I was planning to retire at 65, and there it was. The fundamental flaw in buy and hold advice. To buy and hold works if you have infinite time, if you never need the money, if you can wait out any storm, any crash, any lost decade. But Robert didn't have infinite time. He had 3 years, and the advice that works for a 25-year-old with 40 years until retirement. That same advice destroyed Robert's life plans, because buy and hold treats all investors the same, as if time doesn't matter, as if circumstances don't matter, as if everyone has the same luxury of waiting. Here's what the buy and hold evangelists never tell you. The strategy was invented by and works beautifully for people who don't need the money, wealthy people, people with multiple income streams, people with safety nets. If you're a billionaire and your portfolio drops 50%, you're still a billionaire. You don't need to sell. You can wait 20 years for it to recover if necessary. But if you're a regular person, if that portfolio represents your only financial security, if you need it in 5 years for retirement or 10 years for your child's education, you don't have the luxury of holding through a lost decade. Let me tell you what happened to Robert. He held on. Like the experts told him to, he didn't panic, sell at the bottom. The market started recovering in 2009. By 2010, it was looking better. But then in 2011, his wife got sick, cancer. The medical bills were crushing even with insurance. He needed money, needed it immediately. His portfolio had recovered to about 260,000, still significantly less than his peak. But he had no choice. He had to sell, had to liquidate, had to take the loss. And here's the part that breaks my heart. If Robert had known, if someone had taught him that buy and hold isn't appropriate for someone approaching retirement, he could have protected himself. He could have moved to safer investments as he approached his goal. He could have had some portion in bonds, in cash, in assets that don't crash 50% in a crisis. But nobody told him that, because buy and hold is preached as a universal truth, a one-size-fits-all strategy, and it destroyed him. Now, before you think I'm against long-term investing, let me be very clear. I'm not. I believe in patient capital. I believe in holding quality businesses for decades. I've done it my entire life. But there's a massive difference between intelligent long-term investing and mindless buy and hold. And that difference, it's everything. Fessus the buy and hold myth, let me tell you what buy and hold actually means and what people think it means. Most people think buy and hold means buy index funds and never look at them for 30 years. Ignore crashes, ignore your circumstances. Just hold forever. This is dangerous advice, potentially devastating advice, because it ignores 3 critical realities. 2 reality, 1 time horizon changes. When you're 25, you can be 100% in stocks, a market crash. You have 40 years to recover. It's not even relevant to your life. When you're 45, You need to start thinking differently. You have 20 years. A crash at the wrong time could seriously impact your retirement. When you're 65, you cannot afford to be 100% in stocks. You don't have time to recover from a 50% loss. But buy and hold advice rarely accounts for this. It treats a 25-year-old and a 65-year-old the same. Just keep buying and holding. That's not wisdom. That's malpractice. Let me tell you about two investors. Both started investing in 2000. Investor A was 25 years old. He bought index funds and held through everything. The dot-com crash, the 2008 financial crisis, every correction, every bear market. By 2024, 49 years old, his portfolio had done very well. He'd weathered every storm. He had decades ahead to enjoy his wealth. Buy and hold worked for him. Investor B was 55 in 2000. Same strategy, same index funds, same buy and hold approach. The dot-com crash hit. His portfolio dropped 5%, but he held on. The experts said hold. It took until 2007 to recover. 7 years. He was now 62. Then 2008 hit. Another 50% crash. Now he's 63 and his portfolio is decimated again. He held on. It recovered by 2013. But now he's 68. He needed to retire at 65. He had to keep working, had to delay retirement, had to watch his plans crumble. Same strategy. Different outcomes because time horizon matters. Reality 2. You don't have the same resources as the wealthy. Here's what wealthy investors have that you don't. Multiple income streams, rental properties, business interests, dividends from massive portfolios, pensions, trust funds. If their stock portfolio crashes 50%, it's annoying, but they're not selling their house. They're not skipping meals. They're not devastated. They can hold through anything because they don't depend on that portfolio for survival. 2. But if you're a regular investor with maybe 100,000 or 500,000, that portfolio might represent your entire financial security. A 50% crash doesn't just hurt on paper. It threatens your future, your retirement, your children's education. You can't just hold when holding means risking everything. 2. I knew a couple, we'll call them James and Patricia, middle class, saved 400,000 over 30 years, invested in index funds, classic buy and hold. In 2000, they were 58 years old, planning to retire at 65. The market crashed. Their 400,000 became 200,000. Hold on, the advisor said it'll come back. They held. It recovered by 2007. They were now 65, ready to retire. Then 2008 hit, down to 225,000 again. They couldn't retire. They had to keep working. James had health problems. The job was killing him. But they had no choice. Meanwhile, I knew another couple. Similar age, similar savings, but they were wealthy in other ways. They owned rental properties generating $50,000 a year. They had a business that provided income. When the market crashed, they didn't need to sell. They lived off their other income streams. Their portfolio recovered. They were fine. Same market, same crash, different resources, different outcomes. Different buy and hold assumes you have the resources to never need the money. For wealthy people, that's reality. For small investors, it's a dangerous fantasy. Reality 3, all holdings are not created equal. Here's another myth embedded in buy and hold advice. The idea that you should buy index funds and hold forever, regardless of what's in them. But indices change. Companies rise and fall. What was a good business in 2000 is bankrupt by 2010. Let me give you an example. In 2000, if you bought the S&P 500, you were buying Enron, WorldCom, Lehman Brothers, Bear Stearns, and dozens of other companies that went to zero. But it's diversified, they say. The index rebalances? Yes, but you still own those companies when they collapsed. You still lost that money. The index survived. But pieces of your capital vanished. Now, if you're young and adding money constantly, that's fine. You're dollar cost averaging. You're buying the new components. It evens out. But if you're older, if you're not adding money, if you're in or near retirement, those losses matter. They're permanent. They hurt you. And here's what really bothers me. Buy and hold tells you to ignore what's in your portfolio. Don't look at individual companies. Don't evaluate. Just hold the index. But what if the index becomes overweighted in garbage? What if it's 40% technology stocks at bubble valuations? What if it's full of companies with no earnings, no profits, no sustainable business models? Buy and hold says, doesn't matter. Hold anyway. That's not investing. That's abdicating responsibility. I watched this happen in 1999. The Nasdaq index was packed with companies that had never earned $1. Companies with "come" in their name and nothing else. People bought index funds. It's diversified. It's safe. Then it crashed 78%. Took 15 years to recover. If you bought at the peak in 2000 and held, you didn't break even until 2015. 15 years, zero return. For safe index investing. Now imagine you were 55 in 2000, you retired at 65, you held that NASDAQ index for 10 years, and then you were still down 30% from your peak. You had to live on 30% less than you planned. For a decade, that's the reality of buy and hold when timing and valuation matter. To the small investor's disadvantage, let me explain why buy and hold puts small investors at a unique disadvantage. Large investors, institutions, wealthy individuals, they don't actually buy and hold the way they tell you to. They adjust, they hedge. They diversify across asset classes. They use strategies unavailable to regular investors. I've worked with institutional investors, pension funds, endowments. They'll tell the public, we're long-term investors. We don't panic. But behind the scenes, they're constantly adjusting, rebalancing, using derivatives to protect downside, shifting allocations based on valuation. They're not buying and holding blindly. They're actively managing risk, too, but when they give advice to small investors, just buy an index fund and hold forever. Why the double standard? Because it's easier to manage millions of small investors if they all do the same thing, if they never question, if they never sell. It creates stability for the system, but not necessarily for you. Let me tell you about a pension fund manager I knew. Publicly, he advocated for index investing. Buy and hold. Don't time the market. But his pension fund, it was actively managed, constantly adjusting exposure, using sophisticated risk management. I asked him about the contradiction. He smiled. The pension fund has professional managers an infinite time horizon. Individual investors don't. But we can't tell them that. It's too complicated. Better to just say buy and hold. I was stunned. So you're giving advice you don't follow? He shrugged. It's good enough for most people. Good enough. Not optimal. Not ideal. Good enough. This is the dirty secret of buy and hold. It's not designed to maximize your returns. It's designed to minimize the damage from bad decisions. The thinking goes, small investors are emotional. They buy high and sell low. They panic. If we can just get them to hold forever, they'll at least get market returns. And that's true. Buy and hold prevents the worst behavioral mistakes. But it also prevents you from doing better, from being thoughtful, from adapting to your circumstances. What small investors actually need. So if buy and hold isn't the answer, what is? Let me be clear, I'm not advocating for trading, for market timing, for trying to be clever. Those approaches are even worse for small investors. What I'm advocating for is intelligent, adaptive, long-term investing. The difference between wealthy investors and small investors isn't just money. It's options. When you have wealth, you have the option to be patient, the option to wait out storms, the option to hold through anything because you're not dependent on any single investment. But when you're a small investor, when that portfolio represents everything, you're only shot at a comfortable retirement, your children's education fund, your financial security. You don't have the luxury of being ideological about buy and hold. You need to be practical. Let me tell you about a woman I knew. We'll call her Margaret. Made $48,000 a year. Saved a $200 a month for 30 years. By age 55, she had $180, not a fortune, but enough to supplement her pension and give her a decent retirement. She went to a financial advisor. He put her 80% in stock index funds. Buy and hold, he said. You've got time. This was 2006. 2 years later, 2008 crash. Her $100 became $90,000. She was 57 now, 8 years from retirement. The advisor said, hold. It'll come back. It always does. But Margaret did something different. She called me, asked for advice. I looked at her situation. I asked her, need this money? In 8 years, I want to retire at 65. Can you afford to lose half again? And she was quiet. Then, no. If I lose half again, I can't retire. Ever then you can't be 80% in stocks? I told her. That's not buy and hold. That's gambling with money you can't afford to lose. We restructured her portfolio. We kept 30% in stocks, quality dividend payers that had survived every crash in history. We put 50% in bonds, government bonds, investment-grade corporate bonds, safe, boring, reliable. We put 20% in cash equivalents, money market funds. ready for emergencies. The advisor was horrified. "You're being too conservative. She'll miss the recovery." But Margaret slept at night, and when the market recovered, she participated enough. 3% in stocks doubled her $90,000 portfolio, grew to $145,000 by age 65. Not back to her peak, but enough. She retired. She was okay. And here's the key lesson. If Margaret had stayed 80% in stocks and held, yes, she would have recovered. By 2013, she'd be back to even. By 2020, she'd be well ahead. But between 2008 and 2013, life happened. Her mother got sick, needed care. Margaret had to contribute. She needed money from her portfolio. Had to sell stocks at depressed prices. If she'd been 80% in stocks, she'd have locked in massive losses. But because she'd restructured, she had bonds and cash to draw from. She didn't have to sell stocks at the bottom. That's the difference between blind buy and hold and intelligent adaptive investing. Tooth is the framework, dynamic asset allocation. Let me give you the framework I've used for decades. Not just for myself, but for countless investors who couldn't afford to blindly buy and hold. It's called dynamic asset allocation. It's simple. It's based on 3 factors: time horizon, financial resources, and market valuation. To us, factor 1, time horizon. This is the most important factor. How long until you need the money? If it's more than 20 years, you can be aggressive. 80-90% stocks. You have time to recover from crashes. If it's 10 to 20 years, you need to be balanced. 60-70% stocks. You have some time, but not infinite. If it's 5 to 10 years, 40-50% stocks. A crash could seriously hurt you. If it's less than 5 years, you need to be defensive. 20-30% stocks maximum. You cannot afford a major loss. 2, this isn't timing the market. This isn't predicting crashes. This is simply acknowledging reality. If you need money soon, you can't risk it in volatile assets. Buy and hold ignores this. It tells a 64-year-old retiring next year to hold the same portfolio as a 25-year-old. That's madness. Let me tell you about 2 brothers, David and Michael. Both started investing in 1995 with $50,000. David was 25. He went 100% stocks, buy and hold. Michael was 45. Same strategy, 100% stocks, buy and hold. In 2000, the dot-com crash hit. Both lost 50%. David held on. He was only 30 years old. He had time. He kept adding money. By 2024, his portfolio was worth $800,000. Beautiful outcome. Michael held on too. But by 2010, he was 60 and needed to retire. His portfolio had recovered, but the lost decade meant he was way behind his plans. Then 2008 hit again. He was devastated. He had to delay retirement by 5 years. Work until 65 when his body was breaking down. Same strategy. Different time horizons. Different outcomes. 2, David could afford buy and hold. Michael couldn't. But nobody told Michael that. Because buy and hold is preached as universal truth. Because factor 2, financial resources. This is about cushion, about backup plans. Do you have other income sources, rental properties, a pension, a working spouse, an emergency fund? If yes, you can afford to be more aggressive because your portfolio isn't your only lifeline. If your portfolio is your only asset, you need to be more conservative. So I knew 2 investors with similar portfolios. Both had $300,000. Investor A also had rental properties generating $2 a month, a pension providing $100-500 a month, and a spouse with income. Investor B had nothing else. Just that $300,000. Same portfolio size, completely different risk capacity. Investor A could afford to be 80% in stocks. If the market crashed, he had other income. He didn't need to sell. Investor B needed to be 50% in stocks maximum, because if the market crashed and he needed money, he had nowhere else to turn. Buy and hold doesn't account for this difference. It treats both investors the same. Just hold forever. But they're not the same, and the advice that works for one could destroy the other. Let me tell you what happened in 2008. Investor A's portfolio dropped from $300,000 to $160,000. He was upset, but he lived off his other income, never sold a share. By 2015, he was back above $300,000. By 2024, he was over $600,000. Buy and hold worked for him because he had resources. Investor B's portfolio also dropped to $160,000, but he had no other income. He needed money from that portfolio to live. He tried to hold, but 6 months in, he ran out of savings. He had to start selling stocks to pay bills. He was selling at the bottom, locking in losses. By the time the market recovered, he depleted his portfolio to $80 and he never recovered. He's 70 now, still working part-time, still struggling. Same advice, different resources. Catastrophically different outcomes. To factor 3, market valuation. This is the controversial one, because buy and hold philosophy says never look at valuation. Time in the market beats timing the market. But that's dangerous advice, because starting valuation matters enormously for long-term returns. Let me show you something that should terrify buy and hold advocates. If you invested in the S&P 500 in August 1929, right before the crash, and you held for 25 years until 1954, you earned about 6% annually. Not terrible, but not great. If you waited just 3 years, invested in 1932 at the bottom, and held for the same 25 years, you earned 15% annually, same holding period, same buy and hold strategy, dramatically different outcomes. Why? Starting valuation. Now, I'm not saying you should try to time the market. You can't predict when crashes will happen. But you can look at valuation. You can see when markets are expensive or cheap, and you can adjust your risk accordingly. 2, here's a simple way to think about it. Look at the KP ratio, the cyclically adjusted price to earnings ratio. Historically, it averages around 16-17. When it's below 15, markets are cheap. You can be more aggressive. When it's between 15-25, markets are fairly valued. Normal allocation. When it's above 25, markets are expensive. Be more defensive. When it's above 30, markets are in bubble territory. Be very defensive. This isn't timing. This isn't predicting. It's just acknowledging that paying reasonable prices improves your odds of good returns, and overpaying reduces your odds. In 1999, the KP was over 40, the highest in history except for 1929. Buy and hold said, doesn't matter, just keep buying. But if you were nearing retirement, if you couldn't afford a lost decade, you needed to be defensive. The investors who stayed aggressive in 1999, they suffered for 15 years. The investors who got defensive, they preserved capital and had money to buy during the crash. I'm not saying sell everything when valuations are high. I'm saying adjust. If you'd normally be 70% stocks, maybe go to 50% when valuations are extreme. If you'd normally be 40% stocks, maybe go to 25%, not market timing. Risk management. Where's the dynamic allocation model? So here's how you put it together. You create a target allocation based on your time horizon and resources. Then you adjust that allocation based on current valuations. Then, this is critical, you rebalance systematically. 2, let me give you an example. John is 50, 5 years old, planning to retire at 65, 10-year time horizon. He has a small pension that'll cover 30% of his expenses. The rest needs to come as 400,000 portfolio. Based on time horizon and resources, his baseline allocation is 60% stocks, 35% bonds, 5% cash. But it's 2021. FAPI ratio is 35, near record levels. So John adjusts. He goes to 45% stocks, 45% bonds, 10% cash. More defensive than usual because valuations are extreme. He's not selling everything. He's not timing the market. He's just being prudent. Then 2022 happens. Market drops 25%, bonds drop too. It's ugly. John's portfolio goes from 400,000 to 330,000. But he doesn't panic, because he knew he was being defensive for this exact scenario. And now valuations are more reasonable. So he rebalances back to his 6-year 35-5 allocation, buying stocks when they're cheaper. By 2024, the market has recovered. John's portfolio is back to 390,000, not quite back to his peak, but close. And he's positioned reasonably for the next 10 years. More importantly, he never panicked. He never sold everything. He never felt out of control, because he had a framework, a plan, a reason for every decision. Compare this to buy and hold. A buy and hold investor would have been 80% stocks in 2021 at peak valuations. The crash would have hurt much worse. 400,000 to 280,000. They'd be told to hold, to not look, to trust the process. Some would panic and sell. Some would hold and recover. But all would experience maximum pain and maximum uncertainty. The dynamic approach reduces pain, reduces uncertainty, and often produces similar or better returns. Not because you're timing the market perfectly, but because you're managing risk intelligently. For the setter, the rebalancing discipline. Now let me tell you about the most important part of this framework. Rebalancing. This is where most investors fail. Not because they don't know about rebalancing, but because they don't have the discipline to do it. Rebalancing means when stocks go up a lot, sell some and buy bonds. When stocks crash, sell bonds and buy stocks. You're always doing the opposite of what feels comfortable, selling winners, buying losers. This is psychologically brutal, but mathematically essential. I'll call him Thomas. He set up a 60-40 portfolio in 2009, 100,000 to 60,000 in stocks, of 40,000 in bonds. He committed to rebalancing every year. By 2010, stocks had soared. His portfolio was now 130,000, but it was 70% stocks, 30% bonds to rebalance. He had to sell 13,000 worth of stocks and buy bonds. Sell the winners, buy the losers. It felt wrong. Stocks were soaring, bonds were boring. But he did it. He followed his discipline. Every year, same thing. Stocks would run up. He'd sell some. Buy bonds. Occasionally, stocks would crash. He'd sell bonds. Buy stocks. Always rebalancing back to 60-40. By 2024, 15 years later, his portfolio was worth 3 to 80,000. He'd more than tripled his money. But here's the beautiful part. His maximum drawdown during that period was only 25% a buy and hold. 100% stock investor made more, maybe 40, 20,000. But they endured drawdowns of 50%. Twice, 2011 correction and 2020 crash. Thomas slept peacefully, never panicked, never felt out of control. And he still tripled his money. That's the power of dynamic allocation with disciplined rebalancing. What this means for small investors. So let me bring this back to where we started. Why is buy and hold terrible advice for small investors? Because it ignores your reality. It ignores that you might need the money in 10 years. It ignores that you don't have backup resources. It ignores that starting valuation affects your outcomes. It ignores that one catastrophic loss could destroy your financial future. Full buy and hold works if you're 25 with 40 years ahead. Buy and hold works if you're wealthy with multiple income streams. Buy and hold works if you're investing money you truly never need. But if you're a regular person with a finite time horizon, with limited resources, with one shot at getting this right, you need something better. 2, you need a framework that adapts to your circumstances. That becomes more conservative as you age. That accounts for your resources and backup plans. That adjusts to market conditions without trying to time them perfectly. That gives you a reason for every decision, so you don't panic when markets crash. You know what the most valuable skill in investing is. It's not intelligence, not education, not access to information. It's the ability to stick to a plan when everyone around you is losing their minds. And here's the problem with buy and hold. It doesn't give you a plan. It gives you a slogan. Just hold, but hold for what? Hold why? Hold through what conditions? Hold at what cost? It's not a plan. It's an abdication of responsibility disguised as wisdom. Let me tell you about the moment I truly understood this. It was March 2009, the bottom of the financial crisis. The market had been crashing for 18 months, down 57% from the peak. Every day brought new horrors, banks failing, companies going bankrupt, retirement accounts decimated. I received hundreds of calls, emails, desperate messages from investors. Should I sell everything? Is this the end? I can't take any more. I have to get out. The buy and hold advocates were screaming, hold! This is when you buy more. And they were right, technically. March 2009 was the bottom. Anyone who bought then made a fortune. But here's what the advocates didn't understand. These weren't professional investors with iron discipline and unlimited time horizons. These were regular people, with mortgages, with retirement 3 years away. They were terrified, paralyzed, unable to sleep, and telling them, just hold, wasn't helping, because they didn't know why they should hold. They didn't have a framework. They didn't have a reason to believe. But there was one investor, we'll call him Daniel, who called me during that dark time. He wasn't panicking. He wasn't asking whether to sell. He was checking in, reviewing his plan, making sure he was still on track. Daniel was 62, 3 years from retirement. His portfolio had dropped from 520,000 to 310,000. But he wasn't panicking. Why? Because Daniel had a plan. A year earlier, in 2008, when the crisis started, Daniel and I had built his dynamic allocation framework. Based on his 3-year time horizon, we'd structured his portfolio as 30% stocks, dividend aristocrats, only 50% investment, grade bonds, 20% cash, and money market funds. This allocation meant that when the stock market crashed 50%, it went from 106,000 to 78,000. His bonds dropped a bit too. From 260,000 to 240,000 bonds also fell in the crisis. His cash stayed stable at 1 or 4,000. Total portfolio 422,000, down from 520,000, and 19% loss, painful, but not catastrophic. To compare that to a buy and hold investor who was 80% stocks. They'd had to find a portfolio, 530,000 to 312,000. Same starting point, same market, dramatically different experience. Daniel lost 98,000. The buy and hold investor lost 208,000, double the loss. But here's what really mattered. Daniel wasn't panicking because he understood his plan. He knew why he was 30% stocks, because he needed the money in 3 years. He knew why he had 50% bonds to provide stability and income. He knew why he had 20% cash, so he never had to sell stocks at the wrong time. Every piece of his portfolio had a reason, a purpose, a role. And because he understood the why, he could handle the how. We talked through his situation. You're 3 years from retirement, I said. You need about $35 a year from your portfolio to supplement Social Security. That's 8.3% of your current portfolio, tight but manageable. Your bonds are yielding 5%. Your dividends are providing 3% on the stock portion. Combined, you're generating about $18 in an income without touching principal. You'll need to draw down some cash and bonds over the next 3 years. But the stocks, leave them alone. Let them retire. Daniel followed the plan. He retired at 65 in 2012. By then, the market had partially recovered. His portfolio was back to 480,000, not back to his peak, but enough. And here's the beautiful part, because he'd only sold bonds and cash during the downturn and kept his stocks. When those stocks recovered, they more than made up for what he'd spent. By age 70, 5 years into retirement, his portfolio was worth $520,000, back to his pre-crisis peak, despite taking income for 8 years. Daniel survived because he had a plan, a framework, a reason for every decision. The buy and hold investor. Many of them panicked, sold at the bottom, never recovered, not because buy and hold is wrong as a concept, but because just hold isn't enough when the world is ending. You need to know why you're holding, what you're holding, for how long. You need a plan you can follow when everything in you wants to run. Building your dynamic allocation plan. So let me give you the step-by-step process for building your own plan. This isn't complicated. This isn't for professionals only. This is for regular investors who want to sleep at night. Step 1, define your time horizon. Write down when you need the money, not vaguely, specifically. If it's retirement, what age? How many years from now? If it's a house down payment, what year? If it's college tuition, which year does each child start? Be specific, because vague goals lead to vague plans. Once you have your timeline, segment your money. Money needed in no 2 years, 0 risk tolerance. Cash and short-term bonds only. Money needed in 3-5 years, low risk tolerance, 20-30% stocks maximum. Money needed in 6-10 years, moderate risk tolerance, 40-50% stocks. Money needed in 11-20 years, moderate high risk tolerance, 60-70% stocks. Money not needed for 25 years, high risk tolerance, 70-80% stocks. Most investors have money in multiple time buckets. Some for near-term needs, some for mid-term goals, some for distant retirement. Segment it. Treat each bucket differently. The money you need in 2 years should not be in the same investments as money you won't touch for 30 years. Step 2. Assess your resources. Be brutally honest about your safety net. Do you have emergency cash separate from investments? How many months? Do you have other income sources? Pension, rental income, spouse's income. Do you have assets you could sell if necessary? Property. Business. Could you cut expenses dramatically if needed? To add up all your backstops, your cushions, your alternatives. The more you have, the more risk you can take in your portfolio. The less you have, the more conservative you must be. Both 40 years old, both with 200,000 portfolios. Investor A had 6 months emergency fund, a working spouse earning 60,000, and a rental property with equity. Investor B had no emergency fund, single, no other assets. They're the same age, same portfolio size, but completely different risk capacity. Investor A could be 80% stocks, he had massive cushion. Investor B needed to be 50% stocks. That portfolio was his only security. Step 3. Set your baseline allocation based on time horizon and resources. Choose your baseline. Here are some guidelines. If you're under 40 with strong resources, 80-90% stocks. If you're 40-50 with moderate resources, 70-80% stocks, 20-30% bonds. If you're 50-60 with average resources, 60-70% stocks, 30-40% bonds. If you're 60, then a percentile of 40-50% stocks, 40-50% bonds, 10% cash. If you're in retirement, 30-40% stocks, 50-60% bonds, 10% cash. These are starting points. Customize based on your specific situation. More resources, add 10% more stocks. Less resources, subtract 10% from stocks. Closer to needing the money, get more conservative. Further away, you can be more aggressive. Step 4, adjust for valuation. Look at market valuation. You don't need to be an expert. Just use simple metrics. Check the KEPI ratio as Schiller PE. It's free online, updated monthly. Historical average 1617. Current reading tells you if markets are cheap, fair, or expensive. Is below hood and fee markets are cheap. Add 10-15% more to your stock allocation. If KEPI is 15-20, markets are fairly valued. Use your baseline allocation. If KEPI is 20-30, evade. Reduce stocks by 10-15%. If KEPI is above 30, markets are very expensive. Reduce stocks by 20-25%. You're not predicting crashes. You're not timing perfectly. You're just acknowledging that price matters. That buying expensive assets reduces your future returns. And when you can't afford poor returns, when you have limited time, the price matters more. 2S Step 5, choose quality investments. Now fill in your allocation with actual investments. For stocks, companies that have raised dividends for 25 full years, or index funds tracking total market or S&P 500. Simple, diversified, low cost. Avoid individual stocks unless you truly understand the business. Avoid anything speculative. No penny stocks. No crypto. No, the next Amazon. For bonds, investment grade only government bonds, high quality corporate bonds, or bond index funds from Vanguard, Fidelity, Schwab. Avoid high yield bonds. They're called junk for a reason. Avoid anything that yields more than 2-3% above treasuries. That extra yield is risk, not generosity. For cash, money market funds at major brokerages, or high-yield savings accounts at FDIC insured banks, or short-term treasury bills, safe, liquid, boring. 2 Step 6, rebalance systematically or set a schedule once a year, same time every year, January 1st, your birthday, whatever. Just make it consistent. On that day, look at your portfolio. If stocks have run up and you're now 75% stocks when your target is 60%, sell stocks, buy bonds. If stocks have crashed and you're now 45% stocks when your target is 60%, sell bonds, buy stocks. So always rebalancing back to your target. This forces you to sell high and buy low. It's mechanical, unemotional, disciplined. The only exception, if your time horizon has changed. If you're a year closer to retirement, adjust your baseline allocation accordingly. Become slightly more conservative each year as you approach your goal. 2 Step 7, review and adjust. Life changes, your life changes. Your plan must change with it. Every year, ask yourself, has my time horizon changed? Have my resources changed? New income, lost income? Have my goals changed? Need more, need less? Has my risk tolerance changed? Can I stomach volatility, or does it keep me awake? Adjust your plan accordingly. This isn't market timing. This is life management. Your 50-year-old allocation shouldn't be the same as your 60-year-old allocation, not because the market changed, because you changed. The mental models that make it work. Now, having a plan is necessary, but not sufficient. You also need the mental models, the ways of thinking that let you stick to the plan when it's hard. Mental model 1, portfolios are like gardens. A garden needs different plants, some for shade, some for sun, some that bloom in spring, some in fall. You don't judge the garden by whether every plant is blooming right now. You judge it by whether it thrives across all seasons. Your portfolio is the same. Stocks will have great years. Bonds will have great years. They won't be great at the same time. That's the point. When stocks are crashing, bonds provide stability. When inflation is rising, stocks provide growth. Don't judge your portfolio by whether every component is winning today. Judge it by whether it serves your needs across all conditions. 2S's mental model 2, volatility is the price you pay. If you want stock returns, you must accept stock volatility. There's no free lunch, no high returns without high fluctuations. The 10% average annual return from stocks. It comes with years of 30%. That's not a bug, that's the feature. The volatility, the crashes, the terrifying drops, that's the price you pay for long-term growth. If you can't stomach that price, if it keeps you awake at night, then you shouldn't pay it. Own fewer stocks. Accept lower returns. Sleep peacefully. There's no shame in choosing peace over performance. But don't expect stock returns with bond volatility. It doesn't exist. 2 mental model 3, your plan is smarter than your feelings. In the moment, your feelings will lie to you. When markets are soaring, you'll feel invincible. You'll want more risk. When markets are crashing, you'll feel terrified. You'll want to sell everything. Both feelings are lying to you. Your plan, created when you were calm, rational, thinking clearly, that plan is smarter than your panicked self or your euphoric self. Trust the plan, not the feeling. 2. I knew an investor who wrote himself a letter. When he created his plan, he wrote, "Dear future me, I know you're scared right now. The market is crashing. You want to sell. But remember, we built this plan for exactly this moment. Trust the plan. Trust yourself, hold steady." He sealed it, put it with his investment documents. 2. During the 2020 COVID crash, he opened the letter. Read his own words from his calm, rational self. And he held steady. The market recovered. He was fine. That letter, that message from his better self, saved him from his worst self. The truth about buy and hold D, so let me bring this full circle. Buy and hold isn't terrible advice for everyone. For young investors with decades ahead, it's fine. It works. For wealthy investors with unlimited resources, it's fine. It works. But for small investors with limited time, with limited resources, with one chance to get it right, buy and hold is dangerous, not because the concept is wrong, but because the implementation ignores your reality. 2. What you need is dynamic, thoughtful, adaptive, long-term investing. Investing that accounts for when you need the money. Investing that accounts for your resources and backup plans. Investing that adjusts to market conditions without trying to time them perfectly. Investing that gives you a framework, a reason, a plan you can follow when emotions run high. You need a strategy designed for you, not for billionaires, not for 30-year-olds, for you. Your age, your resources, your goals, your risk tolerance. That's not buy and hold. That's intelligent investing. And it's what separates those who reach their goals from those who watch their dreams die in a market crash they couldn't afford. So please, if you take nothing else from this, take this. Don't blindly follow advice designed for someone else's circumstances. Build a plan that fits your life. Adjust it as your life changes. And stick to it with discipline when the world is falling apart. That's how small investors win. Not by being smarter. Not by predicting the future, but by having a plan they can actually follow through all seasons, through all storms. That's the truth they won't tell you about buy and hold.